Hello, everyone. Jason Gordon, AmeriFirst Financial. It's Wednesday, March 16th, with a quick rate update. As you may have heard by now, or as you will hear throughout the evening today, the Fed has met and decided to raise the federal funds rate by 0.25%. So what does that actually mean to mortgage rates? We get this question quite often. So I wanted to show you here with a quick screen share to show you exactly what is going on in the market since this announcement has been made. So as some of you know, this image here shows a bunch of red and green, what we call candlesticks. Each candlestick summarizes the activity of the market for one business day. This is the playbook that lenders use to change their rate quotes each and every day. And so the way to read this chart is that green is good news, red is bad news. This is for the consumer. So we want to see green. We don't want to see red. The bigger the colored portion of the stick, the more the market moved in that good news or bad news direction that day as a whole. Now, here's the kicker. The higher the sticks appear on the chart, the better it is for the quote. The lower, the worse. You might wonder why. These are measuring mortgage-backed securities, which are bonds, and bonds and rates go in inverse directions. So in this case, just know high is good, low is bad. So you can see over the last 3 months, we've had a pretty steep downward trajectory. A slight bump up here when Russia invaded Ukraine, followed by what can only be described here as a free fall. Now here is today. Today is still in process. We are over, in this case, 66 basis points down right now. Whenever we are over 25 basis points, there's a very heavy chance that we may have a midday pricing adjustment. You see the market's moving right now. So in this case, we did get a lock advisory. Whenever you see these upside down triangles, these are lock advisories. So we've had a few lately, but we're kind of right now in a bit of a free fall. So this is a direct correlation to what we would say good news for the economy and inflation being bad news for mortgage pricing. So that said, if you are a real estate agent or a divorce attorney, and you have your clients pre-approved, whether that for a purchase of a new home or a divorce equity buyout, it is imperative that you speak with your lender again soon, because this change of rates, if the client is not locked in, higher rates equal higher principal and interest portions of the monthly payment, which in turn equates to higher debt to income ratios. So if somebody was already approved and they were kind of on the edge of approval or not approval before all these rate increases, that once approved client might no longer be approved or might have to downgrade the amounts of their approval so that they can mathematically still qualify. Again, I'm Jason Gordon, AmeriFirst Financial. If you have any questions, please reach out to me, 619-200-8031, or visit me on my download my e-card actually at www.vipborrower.com. Have a great day, folks. Bye.